Good afternoon, everyone. Time for another silver update. I decided to take this long holiday weekend as an opportunity to take a look back at some of the historical prices and trends and charts, just to kind of get a long view, longer term look at where we've been and where we're going. So I wanted to start out with this More Research. This is a site where you can get free commodity charts. I like these charts because they are in PDF format, they scale very easily, and they go all the way back a long ways. So for example, this is the silver chart. We can just expand it out. You can see we go all the way back to 1972. So this is where we initially hit $5. And I just wanted to jump over to a calculator real quick. I'm going to be using this a number of times to show you inflation-adjusted prices. Remember, the inflation-adjusted prices are Fed numbers as opposed to shadow stats or other numbers, so you have to take those with a grain of salt. But those come from the Philadelphia Federal Reserve. I'm sorry, this is actually the Minneapolis Federal Reserve page, and you can just put in these prices here. So we want to put in silver was $5 back in 72, and that means it should be $27 today. So based on their stats, just on the rate of inflation, silver is roughly priced correctly as it was in 1972. Now we know that in 1979, silver hit $50 was the peak, and that comes to $155 today. So that's quite a difference. That's from bottom to top. So a bear market today would put silver at 27 at the low, which is close to what we did, and 155 at the top. So that's just one metric there. Now I wanted to look at a couple other charts here from Moore's site. The first one being the interest rate futures, specifically the 30-year and 10-year bonds. Now we've heard a lot about, and I've covered this before, we've heard a lot about the fact that people believe that silver and gold are in a bubble. But as you can see, I believe that this is the actual key bubble to all the markets. This is the 30-year bond that starts at a price below 50 in 1980, 81, and is now up to almost 150, which means interest rates going to zero. I'm not really sure what price it is on this chart that equals a zero interest rate, but we are rapidly approaching that place. You can see the 2008 crisis resulted in this spike. We have actually come and tested that, and now we've rallied past that. So we actually, as far as interest rates go, and again, this is a 30-year, we'll check the 10-year next. As far as interest rates go, this is at all-time historical highs, which would indicate that we're actually in a worse recession than 2008. So let's look at the 10-year note, because that's actually the real live note. The 30 years actually been retired. And we get something similar with the 10-year. You can see we've just ticked above the high in price, which obviously corresponds with the low in yield that we had in 2008. So very interesting that we could see the pig nations, or as some like to call them now, the gyp nations. These nations are seeing blowout interest rates, and we're talking about interest rates really aren't that high historically, maybe 7%, but they're considering that a blowout in the environment that we have in the rest of the world with very low interest rates. So we're seeing these nations, their bonds are being sold off, which is causing their interest rates to rise, which means that they're a risky bet. And I think probably the biggest question out there right now is, why aren't U.S. interest rates rising? And I think we know the answer, because the Federal Reserve is buying the bonds. So the bond vigilantes are dead. They don't exist anymore, and the buyer of last resort is now the buyer of first resort, and that's the Federal Reserve. So how long can this go on? I don't know. Some have speculated that it will go on until the Federal Reserve is bankrupt. We'll have to wait and see. Now I want to look at a couple of other charts here that I consider key These are called the soft commodities. It includes OJ, sugar, coffee, cocoa, lumber, cotton. And if you remember back on the silver chart, we have, if you look at the steepness of the spike that we get on this chart, it appears that we're in something similar to this crash that we had in 1980. And it's my contention that actually, no, we're not. We're actually going to be building a base around in here, and then we're going to launch much higher and create a whole new breakout. But I wanted to show you that in some of the other commodities, specifically the softs, you can see it. For example, in sugar, and this is one that I had been playing with when I was playing with the futures, and I wanted to buy this at 5, but I got in too early, got shaken out, etc. I was right about this rise. But you can see when you look at the sugar chart, it's not... Now you have to remember when you're looking at these commodities that they spikes that we see in the commodities often have to do with particular crop situations and not necessarily monetary situations. So these spikes that we had back in the early 70s and late 70s possibly had something to do with the sugar crop and whether there was a bad crop year or a shortage because of various other things. But what we're starting to see now here is kind of a higher base building. This is not a spike and crash. This base is building for the last 4 or 5 years. So I don't think we're going to go back down like we did last time. And really, there's no reason we should. If you look at these prices, the base here, we broke out of, say, 10, roughly 15. Let's just use a base price of 15 because this seems like a fairly average line for where prices went to. And if we go over to our calculator in the Federal Reserve, if we look at 1972 prices for sugar at around 15, an inflation adjusted price is going to yield 81. So you can see we've never even hit 81 before. So that is a good example of where, even using the Fed's own figures, the prices for commodities are still very low, very cheap. The other one I wanted to look at is cotton. And you can see with cotton, it had a big spike. Now this spike on cotton is a unprecedented spike. You can see your mini spikes with various crop occurrences, etc. But this type of spike that we have here is unprecedented. Now, I'm not that up on the cotton market, and I don't know whether we had a terrible crop one year and that's what caused this. But you can see this spike is outside of anything we would expect for the normal cotton crop. Now, again, we want to take this price, and you can see that 80, we'll just take 80 as roughly the figure that we want to use as far as an average over this course of years. So if we had 80 back in 1972, that's going to equal about 433 today, just accounting for inflation. And you can see that 80 for all these years, is just as recently as 2009, our high was 80 before this breakout, and we're coming back down towards it. But we're talking about $433. That's a price we haven't even hit half of that. So again, the commodities are still very underpriced for the amount of money that's been printed, even just based on the Fed's inflation figures. We're not even looking at the QE figures and all the other crazy money printing that's gone on since the 2008 crisis. So we're still very low price rise, and I think that's true for silver. My main point is that I think we are now building new base formations, and they're going to be above these old highs. I think that's going to be the case for silver. I think ultimately 50 is going to become the base for silver, and then it's going to build higher from there once it gets through that point. Now I wanted to segue over to an article that is about this topic and goes into quite a bit of the historical information, and this is by Hubert Moolman, and he's out of South Africa apparently, and I found his channel on there. I'll put links for that. But he gives kind of a historical perspective, especially regarding the silver and gold ratio and why silver is an asset for monetary collapse or deflation. And so we'll jump in and read a little bit of that. We are at the edge of a major economic crisis. Our monetary system is the underlying cause of this major crisis. The massive debt bubble created by our monetary system is about to burst. The demonetization of gold and silver has over the years diverted value from these metals to all paper assets, such as bonds. Remember that bubble that I showed you, linked to the debt-based monetary system. The process of the devaluation of gold and silver, started by the demonetization of gold and silver, is about to reverse at a greater speed than ever before. This is similar to what happened during the late 1970s when the gold and silver price increased significantly. However, what happened in the 70s was just a prelude to this coming rally. The 70s was the end of a cycle. This is like the end of a major cycle, an end of an era of the debt-based monetary system, dishonest money. The type of assets that people will flee to depends on the extent to which the assets offer protection against a specific crisis. For example, if people are extremely thirsty, then most would likely go for water instead of milk or soft drinks. They would therefore rank water higher than soft drinks or milk. The reason that they would go for water is due to its superior properties for countering the thirst crisis. In a similar manner, people will run to the assets that have the ideal properties to counter risks and issues brought about by this economic crisis. Most people in the hard money camp will agree that gold is the asset that people will flee to in this economic crisis, but for some reason there are those, sometimes respected analysts, that believe that silver is not that safe haven asset. I believe that people will and are running to gold, not because gold was ordained by some divine providence or something, but because it has those specific properties to offer protection against the crisis, properties given by God. It follows naturally that whatever assets have similar properties will be similarly in big demand as a safe haven. What are the properties of gold that offer so much protection against this crisis? Simplified, it is important to understand that the true nature of this crisis is monetary. Therefore, assets that possess monetary properties will be premier assets. The issue here is not whether gold, silver, or other assets are money or not. It is whether they have monetary properties, because that is what people will be after. Good money should be effective as a store of value, a medium of exchange, as well as a unit of account. In order for money to be effective in the above, it has to have the following properties. Divisible, should be divisible into smaller units. Portable, able to carry it around, therefore a high value should be able to be contained in a small space and weight. Homogeneous, one unit should be the same as any other unit. Durable, should not be able to be easily destroyed or eroded. Valuable, should have intrinsic value, normally because it is desirable. Should not be able to be created or discovered without reasonable effort, normally a commodity itself. Gold has all the above properties. It is almost a perfect fit. How about silver? Is it not also a perfect fit? In fact, silver is a perfect fit as much as gold is. There is not much to choose between the two. Gold and silver are the two assets that best fit the above properties. Therefore, both will be the assets in most demand. If someone tries to convince otherwise that silver will not offer protection like gold, he has to show how silver does not fit the properties that will offer protection against the crisis, the above listed properties. Personally, I prefer silver over gold, mainly because silver offers better value as a result of it being one of the most undervalued assets today. It is less likely to be confiscated, at least for a while, and is more accessible for now due to its lower price. However, I recommend both. And he goes into chart analysis, and this is something I want to touch upon next. The key line that he gives in this chart analysis is 1870, and that is the demonetization of silver. And this top chart here is the silver-gold ratio, and his argument is that it's a failed double top and that it's coming back to the historical 15 to 1 silver gold ratio. I think it's actually going much farther than that. Now this next chart is the Dow gold ratio, actually, and he's pointing out that we seem to have a double top on that. A lot of people have predicted that the Dow and gold are going to go to a 1-to-1 ratio. I've lined up the two charts. I will only point out a few things here. The first thing is the double top in the gold-silver ratio and the recent failed attempt at the 80 level to test the highs. This makes a test of the all-time highs very unlikely and a test of 16, the bottom between the two tops, very likely. I had drawn a vertical blue line approximately where silver was demonetized, 1870s. Notice how the gold-silver ratio started rising, becoming very volatile with 3 massive peaks eventually forming. The Dow-gold ratio also made 3 massive peaks after the blue line. The Dow-gold ratio, when high, is in some way a proxy for the extent to which the value is diverted from real money to paper assets. The 80 years before the blue line, silver and gold was generally still money. The gold-silver ratio was reasonably stable and lower than 20, and the Dow-gold ratio was at lower levels. After the blue line, the gold-silver ratio rises significantly and becomes very volatile. The Dow-gold ratio also rises significantly, showing the extent to which the value is being diverted from real money, silver, to paper assets. After gold is demonetized by the 30s, the Dow-gold ratio rises even more, making higher peaks and showing the extent to which value is being diverted from both gold and silver to paper assets. This trend has been reversing since about 1999. It is likely that the speed of the reversal will soon intensify. Notice how the Dow-gold ratio tested the 1 level in 1980. That level is incidentally the key level at which it broke out during the 1870s, which is exactly when silver was demonetized. At the same time in 1980, the gold-silver ratio also made a significant low of about 16. Both ratios were attempting to go back to pre-1870 levels. Was it a coincidence that both ratios tested the 1870 levels? After the double top, it's almost certain that the gold-silver ratio will go back to the 16 level and even look to touch the extreme level, lower at possibly 7. Now, I believe actually it's going to be less than 1-to-1. And he says that here. Technically, based on the extreme highs of the two peaks of the double top, a ratio of 1-to-1 is not impossible. Based on the true fundamentals, it is reasonable to expect things to settle at pre-1870s levels eventually. That is, that gold and silver will be used as money with the gold-silver ratio at between a possible 10 and 16. For more detailed analysis, and he gives you his website. So, I wanted to go next to the famous 600-year silver chart. I've actually put this on my desktop because it's hard to find this. If anybody can find this 600-year silver chart in a larger format rather than just a small picture, I'd appreciate it. But this is the largest one I could find. This chart shows the inflation-adjusted price of silver. This is the blue line. This is inflation-adjusted price of silver in 1998 dollars. This line is the gold-silver ratio. Now, the first thing that stands out is that the gold-silver ratio was steady for a very, very long time. You can see 20 and 10, so roughly 16, very, very steady. About 1344 through 1644, so there's 300 years where this ratio really barely budged, and then you pretty much got another 200 where it didn't do much. So you've got almost 500 years of this not really even moving. Now, if you look at silver, you can see this. The first mark is that the European mines were diminishing, and that was what caused this all-time high where we get 806. That's in 1998 inflation-adjusted dollars. That's $806 an ounce for silver. Now that was followed by the New World discoveries, and of course they found a ton of silver with the South American, Central American, American discoveries, and a lot of that was hauled back to Spain and Europe, etc. So that caused the price of silver to fall, and it started to stabilize, and that's until we get about to, well, we have minor drop here, well, actually a fairly decent drop here, but we don't really get an explanation for that one. But then when we get to the late 1800s, we have two events that happen simultaneously that are very, very bearish for the price of silver. The first one is the 1870 demonetization of silver. So we had the governments of the world deciding that they weren't going to use silver as money anymore. Well, of course, if that is the role that silver had served for nearly 500 years just on this chart alone, and for the governments all together to decide that they're not going to use it as money anymore, is a very bearish situation for silver, because there's a ton of silver lying around and there's no use for it if it's not being used for money except for jewelry and other things like that. So that was a huge shock. But at the same time, or very close to that time, we had the western U.S. silver discoveries. So we had the Comstock Lode, we had these other gigantic mines discover enormous amounts of silver, and these two combined just caused a collapse in the inflation-adjusted price of silver and an explosion in the gold-silver ratio. And you can see the gold-silver ratio actually peaked at 153 in 1939. Now, that was the point that the gold-silver ratio reversed and started down, rallied again and started down. The silver price actually didn't bottom until 1992, when we get this price of $4.73. So this is the point where these major trends have gone into reverse, and of course these reasons don't exist anymore, because as they demonetized silver at this point, with the bullion being offered by the governments, silver is slowly being remonetized. Now, of course, so that's the demand side of the equation. Now, the supply side of the equation, we're at the exact opposite point on supply as well, because these massive silver discoveries that occurred here and back with the New World discoveries, all that silver was carried forward into the industrial age and now has been all used up, because the United States ended up stockpiling most of that during and after the war, and now the United States has to buy silver to make the silver eagle coin. So this is a long-term perspective. Now, I believe we're going back to at least the historical and perhaps even beyond that. So let's just go back to the historical of where silver was used as money and it was trading against gold. So let's take our all-time high of 806, and that's going to be in 1998 dollars, so we're going to have to adjust that based on inflation. So we will put in 806 as our number, and then we're going to say that 1998 was the time we had that price, and then this will give us today's price. So today's price, if we go back to the price that we had as a high, then will be over $1,000 an ounce. Now that's at a 15-to-1 ratio. So I believe that we're going back to at least a 1-to-1 ratio. If we go back to those historical prices based on inflation, and we also go to a 1-to-1 ratio, that's going to give us roughly $15,000 an ounce silver. So that's the long-term perspective. That's actually where I think we're going. I think we're actually looking at the reversal of a 600-year trend here, and it's going to be marked by very violent moves to the upside once silver breaks out and builds that $50 base. And we'll talk to you next time.